whoever's watching, don't invest in anything which is not quality. Right now, you can interpret quality your own way, Mr. or Mrs. Viewer. You can interpret quality your own way, but don't invest in companies where the books aren't clean, the promoter's track record of high quality capital allocation isn't well established, and the balance sheet isn't rock solid, right? Now, if you then say, look, Saurabh, here's 3 portfolios, large, small, and mid, each of them high quality, which one would you go for? I would unquestionably say, go for large caps in this sort of circumstance. I think we'll see a classical setup again. Classically in India, if you go back 10 years, 20 years, classical in India, going into an economic slowdown, you tend to see IT services, pharmaceuticals, and FMCG do well. I think for a whole bunch of reasons, I think these 3 sectors are in good shape. In IT services case, the American rate cutting cycle has begun. In FMCG's case, I think the government, after the 4th June verdict, the government has become far more proactive in giving SOPs and subsidies to the poor. And in the case of pharma, both the demand coming from the Western world and the fact that the Chinese are banging down the prices of raw materials which go into pharmaceuticals, puts the pharma sector in a good place. So I think IT, pharma, FMCG going into a classical economic downturn should be good safe harbors. And within those sectors, look for well-run, clean, high-quality companies with stellar track records of capital allocation.
And firstly, last Samvat was a great Samvat. But I think what has happened is the market is distinctly rewarding themes and opportunities where it sees growth. And growth is, so if I look at the case of defense in last Samvat, if I look at the case of select capital goods companies, select retail names, where it is seeing disproportionate earnings growth in the case of capital goods, order books, profit growth, you are getting rewarded. And where there are questions about growth, banking, deposit growth, you perhaps not get rewarded. So, there are pockets of what you would call value, and then there are pockets of, sharp momentum that are happening. In the last couple of months, I do believe, as some of those momentum pockets have gotten a little expensive, there has been some sector rotation. For instance, IT, and we launched a fund in March, is now getting out of the woods. IT has been re-rated as a sector. I think some energy is coming back into consumption as a theme. So, all of that. So factor-based, we are large players in factor-based, both active and passive. We think it's a great category. And we think actually the theme has just started to play out. So people's understanding of investment styles into different factors, being able to take exposure to factors, I think that will rise. For instance, there's now belief that value as a factor has done extremely well and quality has underperformed. But perhaps quality as a factor will start to show some legs. So I think factor investing will continue to take off. Thematic investing, good or bad, has been extremely popular. And I think themes will continue to be popular with consumers, although I really believe they should exercise discretion in themes. But I think dal chawal investing has gotten a little out of favor because it's extremely boring. I hope that makes a comeback this somewhat.
At this point of time, our view is that in debt, go for longest possible maturity or duration. Gold, we are bullish on gold prices and hence one should invest slightly overweight position to gold. In equity, we think it is time to be neutral weight, no leverage position, no overweight position. And within equity, focus more on quality over momentum, focus more on large cap over mid cap or small cap, and focus more on reasonable valuations than expensive valuation. We believe sectors like capital goods, infrastructure, defense, railway, consumer durables, they have become expensive. They are trading well above historical average valuation, and they'll have to deliver much higher performance to justify today's valuation. It's like Rohit Sharma scoring a century in first inning. We expect them to score century in second inning. If he scores, then we expect next match first inning century. At some point of time, law of average catches up with them. On the other hand, there are sectors like bank, IT, pharma, consumer staple, telecom, auto, cement, where valuations are still reasonable. Some are below historical average, some are above historical average, but overall valuations are still reasonable. And hence, I believe it is time to go into reasonable valuation companies across sectors to write the India growth story.
For me to tell, in the last 2 to 3 months, the trends are reversing already. In the last 3 months, the best performing sectors are IT, consumer, and pharma. So market is already rotating, right? So I think I suspect that people's portfolios are where the market was 1 year back, right? And I think in every which way you look at it, people need to rebalance their portfolios.
So there has been a shift, and you see that sectors like IT, consumer, discretionary, etc. performing well going ahead.
Yeah, even banks, if you really ask me. See, you should be counter-cyclical. So I think that, and market is already rotating. And you should not be just sticking to where you made disproportionate return in the last few years, because market works on relative value. Correct? So yes, the rotation has started, and I think the rotation will continue, and a different set of sectors will do well. Even compared to, say, small cap, or at least say compared to mid cap, for instance, maybe large caps would outperform. Small cap is a very big universe. We consistently keep getting new ideas. So let me not generalize on small cap, because the universe is really big, and there is always new ideation happening. But mid cap is a very constrained universe, right? So I would say you should be in large cap for that matter. What people need is they need to rebalance. What it means is that in the last 3 years, it is highly likely that if you were supposed to have 80% in equity and 20% in debt, or if you're supposed to have 50% equity and 50% debt, if you were supposed to set some money aside for some goals, in the last 3 years, highly likely that compared to your targeted allocation, or compared to what you intended to put in equity, you have put a lot more compared to what you should have otherwise, right? Because what happens is the asset which appreciates, uska weightage portfolio mein वैसे ही बढ़ जाता है, and then people are greedy, so they will anyway put money where it is appreciating. So your weightage would have, so if you have crossed your desired level of allocation, you need to definitely reduce that. Second thing, let's say you are saying that no, I am in equity, I'll remain in equity. But within equity also, chances are that in the last 3 years, your portfolio would have a lot more small and mid cap, a lot more railways and defense and infrastructure and PSU and whatever has worked would be more. So you need to bring your portfolio to the center of the market. The center of the market is still the large caps and the financials and the IT and the consumer and pharmas of the world. Defense and railway and infrastructure is not the center of the market.
We've been telling people if you want to invest now, there's more sense in looking at hybrid solutions because they will help you address asset allocation. The reality is that in the investment journey, you do not control the variables. You are dealing with things which are unknown. When you are dealing with things which are unknown, it is better that you focus on controlling what you can manage. You can manage your risk appetite, you can manage your asset allocation because it is linked to your financial goals. So our advice to people has been consider the hybrid solutions at this point of time. They will allow you also to stay in line with your defined asset allocation patterns. This is not the time to look at taking on more risk to increase your short-term return. Is that you have now borrowed some returns from the future. That's the reality. So be cognizant of that in your asset allocation. Secondly, for you to expect, in my opinion, that you will be able to get returns better than earnings growth from this current starting point is a very dangerous assumption to make. Your best case returns would be equal to earnings growth, with the caveat that because valuations are elevated, at some point of time your returns could dip to below earnings growth simply because valuations start to normalize at some point of time. So, that's the thought process with which I would look at the equity markets at this point of time. If you're a long-term investor through the SIP route, keep going with the SIP. That's not an issue. Focus on your asset allocation. That would be my big message to investors because that is within their domain. That is what they can manage. They cannot predict what will happen in Russia and Ukraine, what will happen in Israel, and the fighting happening in the Middle East, what will happen in the US presidential elections, what will Chinese policy be, will there be a Cold War between US and China? We can talk about this till the cows come home, but we will never reach any conclusion. So focus on what is within your control. What is within your control? Your risk appetite, your asset allocation, your financial goals. Forget everything else.